Welcome to my channel. This is a course series for people who are new to investing, finance, and accounting, and for anyone who wants to build a clearer investment research framework from zero. We are going to cover accounting, finance, and macroeconomics, but we will start with accounting. Why accounting? Because before we analyze stock, valuation, or macro trend, we first need to understand how a business actually works. And financial statement are the language business use to describe themselves. Today, we start with a balance sheet. You have probably heard this equation before, asset equal liability plus equity. But what does that actually mean? What is the difference between asset and equity? If I buy a $30,000 car, am I automatically $30,000 richer? And if I borrow money from a bank to buy that car, where does that borrowed money shows up? To answer these questions, let's start with a very simple example. Imagine you want to become an Uber driver. You have your own $10,000, but the car you need costs $30,000. So right now you have a problem. You have some money, but not enough to buy the car. This is a simple personal example, but it already contains the logic of corporate finance. A business needs resources to operate. In this case, the resource is a car. But resources need to be financed somehow. They can be financed by your own money or by borrow from someone else. This is exactly what a balance sheet is designed to show. Before buying the car, your balance sheet is very simple. On the left side, we have asset. Right now, your only asset is cash, $10,000. On the right side, we show where the asset come from. You have no liabilities yet because you haven't borrowed any money. The $10,000 comes from you, the owner, so it's owner's equity. The balance sheet balances. Assets are $10,000. Liabilities plus equity are also $10,000. This is a very first important intuition. The left side tells us what resources the business has. The right side tells us the source of those resources. Now suppose you go to the bank and borrow $20,000. The bank loan is a liability because it's money you owe to someone else. Together, the $20,000 from the bank and your own $10,000 give you $30,000. You use the $30,000 to buy the car. Now the business has changed. You no longer just have cash. You now have a car that can be used to generate revenue as an Uber driver. But the car was not for free. It was financed partially by the bank and partially by you. This is the heart of the balance sheet. Now let's put this into the T account style balance sheet. On the left side, we have assets. In this example, the asset is a car, worth $30,000. On the right side, we have liabilities and equity. The bank loan is $20,000. This is a liability. Your own $10,000 contribution is owner's equity. So the balance sheet equation is asset equal liabilities plus equity. 30,000 equals 20,000 plus 10,000. This is why the balance sheet must balance. Every resource on the left side must have a financing source on the right side. Now let's make the example a little bit more realistic. If you want to drive for Uber, you probably do not want to spend every dollar on the car. You may want to keep some cash for daily operations such as gas, parking, maintenance, insurance, or emergencies. So instead of borrowing $20,000, suppose you borrow $21,000. Now you buy the $30,000 car, but you also keep $1,000 in cash. On the asset side, you now have two assets. Cash of $1,000 is a current asset. The car worth $30,000 is a non-current asset. Current and non-current classification applies to both asset and liability. Current usually means something is expected to turn into cash, be used, or be paid within 1 year. Non-current usually means it will remain in the business or be settled after more than 1 year. So here, cash is current because it's liquid and available for near-term use. The car is non-current because it will be used over a long period, at least more than 1 year, right? Once we understand the balance sheet, we can start calculating simple financial ratios. Financial ratios help us summarize a company's financial health. Two basic ratios are the debt to asset ratio and current ratio. The debt to asset ratio is total liabilities divided by total asset. In this example, total liabilities are $21,000 and total assets are $31,000. So the debt to asset ratio is about 67.7%. A lower debt to asset ratio is usually better because it means that less of a company's assets are financed by borrowed money. A higher debt to asset ratio means a large part of a company is financed by liabilities. The current ratio is current asset divided by current liabilities. Here, current assets are $1,000. If we assume the bank loan is current debt in this simple example, current liabilities are $21,000. So the current ratio is 0.05 times. A higher current ratio is usually better because it means that a company has more liquid asset relative to short-term obligation. So the big idea is this: assets are resources used to generate revenue. Liabilities are obligations onto creditors such as loans. Equity is the owner's contribution or claim. The balance sheet equation is always asset equal liability plus equity. This simple equation is not just an accounting rule. It's a way to understand how a business is financed. When you look at a real company, you can ask, how much does a company own? How much does it own? And how much belongs to the shareholder? This is why the balance sheet is starting point for investment research. Now, let's move from Uber driver example to a real company. Here is Apple balance sheet. Before looking at the answer, try to identify 5 things. First, what are Apple's current assets? Second, what are Apple's non-current assets? Third, what are Apple's current liabilities? Fourth, what are Apple's non-current liabilities? And fifth, what is shareholders' equity? Then try to calculate two ratios, the debt to asset ratio and the current ratio. Use the September 27, 2025 column. This exercise is important because real financial statement looks more complicated than our simple example, but the logic is exactly the same. Now, do you get the right answer? The debt to asset ratio is about 79.5%. This means the large share of Apple's asset is financed by liabilities. The current ratio is 0.89 times. That means that Apple's current liabilities are larger than its current asset at this point in time. But remember, ratios are starting points, not final conclusion. A strong company can still have a current ratio below 1 depending on its cash flow, business model, and access to financing. Finally, there's one very important feature of the balance sheet. A balance sheet is a snapshot. It doesn't show what happened over the entire year. It shows the company's financial position at a specific date. In Apple case, this balance sheet gives us two snapshots, September 27, 2025 and September 28, 2024. Think of it like a photo, not a video. A photo captures one moment. A balance sheet captures what a company owned, what it owned, and what belonged to the shareholder at a specific moment. Later, when we study the income statement and cash flow statement, we will see the video side of the business. Revenue, expense, profit, and cash flow over time. But for now, the key takeaway is simple. The balance sheet tells us the company's financial position at a point in time. So that's all for today's lesson. Since I'm a still new YouTuber, I would really appreciate any feedback. If something was unclear, too fast, too slow, or if you have suggestions for better examples, please let me know in the comments. If this video was helpful, please like, subscribe, and save it for future review. I'll also put a PowerPoint slides in the link below, so you can download them and go through the example by yourself. And of course, if you have any question or idea for future topic, please feel free to leave a comment. Thanks for watching, and I will see you in the next lesson.